The Japan debt bomb is worse than you think, and there's over 240% debt to income ratio, or GDP to actual citizen, in Japan, which is absolutely terrible. Equivalent to you having to make 100 grand a year and having $240,000 in debt. So today we're going to discuss exactly what this means for you, what this means for the bond market, and the reasons you should pay attention is very simple. When there are bond movements in Japan, there are bond movements in the US. And the reason why is they're the biggest carrier of our debt. So with that being said, let's jump into it. So what is exactly happening with the Japan debt bomb and why are they such in bad debt? Mainly, it's because of us, actually. So Japan's bond market just hit a 20-year high. So why this matters is Japan holds $1.1 to $1.2 trillion in US treasuries. Obviously, this depends on which article you review. That's a lot. That's a lot of treasuries. Rising Japanese bond yields can impact the US mortgage rates, stock evaluations, the US dollar, and retirement portfolios. This would essentially touch every single piece of every American's life. So the current situation is this: bond yields are rising in Japan. Recent milestones: 30-year Japanese bond yields, highest in 20 years, 10-year Japanese bond yields, highest since 1998. Why this matters: higher Japanese yields can pull global capital back to Japan, affecting markets worldwide. So just like I was explaining earlier, this is actually pretty crazy. So imagine if you're making 100K a year and your debt to income is, 125%, which is what it is in the US. Typically, when you go to actually qualify for a mortgage, they don't want you having over 35, 40% debt to income ratio. We might have all heard that before if you've applied for a mortgage. With Japan, they're at 240% on average. So it's quite high, considering on the graph you can see that a concern level is 90%. So the US is 125%, 125%, so it's already 35% higher than the concern level. And then Japan is way up there in the distance. So why is this? Let's talk about it. And we have to discuss the reasons why, because it matters a lot on how this is going to affect your portfolio and ultimately our spending power in the US. Okay. So you can see just how much the percentage of GDP has grown in terms of debt over the past few decades. Other countries remaining at similar levels to the United States, but this purple line here obviously showing Japan going all the way up to 240%. You can see it was actually higher a few years ago in 2020 when obviously rates were super cheap, purchased lots of bonds to obviously make that back. So why is Japan getting into this much debt? In the 1980s, a asset bubble burst. So Japan experienced one of the biggest bubbles in history, with stock market doubled and tripled overnight, real estate prices tripled, massive lending in fueled speculations. And I'll actually pull up a graph here. You can see closer to the 1990s as well, there was this massive inflationary period. It was hyperinflation. Everything was doubling, tripling. People were happy, making lots of money. But when there's a hyperinflation situation, like you might have heard in Venezuela as well, what comes up must come down eventually. And as you can see, they just had 3 or 4 lost decades in a row where it didn't even return close to market highs. I mean, we're talking about an 80%, 90% decline in the market. Now, it's recently started going back up, and it's actually passed those resistance levels, as you can see, in 2023. Okay. Obviously, right now we're peaking quite a bit. So how does this actually affect what we're talking about today with the debt? So famous example of this, by the way, before we jump to the next one, is the Imperial Palace land was valued higher than all of California real estate combined. So it just shows you how expensive things were, especially in the 1980s. Which is pretty crazy. This bubble burst in the 1980s. So Japan experienced one of the biggest bubbles. So let's look at their inflation rate to understand more the backstory behind this. So 2025, it's been going down slightly with their inflation rate. So that's been decent. But what we see, especially right now, is when the bubble burst, there was a long stagnation and more of a deflationary period. So the crash basically brought prices down. They began falling. Economic activity slowed. Consumers displayed less spending and less intent to spend. Because the thing is, if you were to buy this iPhone and you were to buy it today and it was valued at $1,000, but if you could buy it tomorrow, it was $990, wouldn't you just wait a few months till it just kept going down in value? And it's still brand new. No one's touched it. So that's what was happening in the deflationary period. People weren't spending their money. And when consumers don't spend their money, that means that companies have less profit. less sales, and then less jobs are created, and that whole cycle leads down sometimes a really bad path. With the deflation, here's the problem. If prices fall in the future, people delay purchases today. This causes lower business activity, lower wages, and then economic stagnation. Japan's deflation lasted about 15 plus years. And this is the important piece that we have to discuss. How Japan managed the crisis was the government responded by massive borrowing, stimulus spending almost. Instead of the consumer spending, it was the government, and ultra low interest rates. So the two key institutions here, the governments issued debt and the central bank manages monetary policy. So the Bank of Japan intervention was pretty extreme. It was very extreme. The Bank of Japan implemented the quantitative easing, 0/negative interest rates. So imagine negative interest rates, and then yield curve control. The results were the Bank of Japan owns 50% of all Japanese government bonds, and it owns 90% of the 10-year bond market. In effect, the bond prices go up and the bond yields go down. So this did work, at least for a while. Cheap debt servicing, Japan owes about $8.6 trillion. But because rates were nearly zero or negative, debt servicing cost essentially nothing. It was super manageable. And the system worked during deflationary times. Now, just as we looked at the chart, the markets are getting up there and we are seeing inflation again. So we're out of this deflationary space with Japan. And I'm going to get into it in a second with how this is going to affect us. But inflation is now reappearing in Japan. So inflation appearing is now a new problem because rising prices, so everyday goods rising, 5, 10, 15%, which in some areas has been pretty common, such as food, convenience items, are just more expensive for the consumer's budgets. And the current interest rates are about 3%. So this creates quite the dilemma on what is actually going to happen in the bond market. So there's two bad options here. Option one is they raise interest rates. The problem with this is the debt that they have, so the 8.6 trillion becomes way more expensive. And that's a lot of debt to have. Remember, they have 240% debt to income ratio. That's a ton of debt. They probably won't even have enough income coming in from the taxes, especially because their population is aging, which we'll get into in a second. Option number two is they keep rates artificially low. The problem with this is Japanese yen collapses, which is obviously might be even considered even worse. So two very bad options. And this is why this matters globally. The yen carry trade borrowed cheap yen. They converted this to the US dollar. And then they invested in US assets. So our bond market, the stock market. So examples of this is treasuries and our stocks. Okay, so why they did this was it was borrowed at 0%. So it was essentially free money at the time. And then you could bring it over to the US, earn about 4 to 5%, like very conservatively, very, very conservatively, and then make your money. So imagine if you had $1 billion, $1 billion, and you borrowed it at 0.1%, literally nothing. And you invested that at 4.5%. So your profit spread would be 4.4%. So you'd make 44 million a year on autopilot doing essentially nothing to earn that money. You got it for free. You invested it. You're doing nothing. You make 44 million. Sounds pretty nice. So this is what was happening for many, many years. Now, the piece where this kind of falls apart is when Japan's rates rise on their debt, now there's just a higher borrowing cost, the currency hedging, conversion fees, the profit spread is shrinking to minimal, 1%, less than 1%. It makes it not as worth it to invest in the US market. So it causes people to want to unwind these trades. And that's what we're seeing right now is these people who invested trillions and trillions of dollars into the US equities, stock market, and the bond market are now saying, well, I want my money out. So they're selling foreign assets. They're converting dollars back to yen, which is paying down their loans. But in result, it gives us less of spending power and control over other people investing in the US market. So why this truly impacts Americans is the first main reason is mortgage rate increases. So 1% increase on a $400K mortgage is $250 more a month, and it's $90K more interest over 30 years. That has pretty devastating impacts for a lot of people across the US that have mortgages. Impacts on the stocks. There's higher interest rates hurt valuations on companies. And many stocks are devalued, or many stocks are actually valued using discounted cash flow models. So when rates rise, future earnings are discounted more, and that results in stock valuations drop. So we could see a natural market sliding over the next 6 to 9 months, not because of the Iran conflict or because of AI, but because of a mix of the three and this. Now, if you remember back in April last year, we had a situation where in Japan, they liquidated a bunch of debt that they had invested in the US market. And when that happened, we did have a dip. We had a slide back. I forget how much it was, but it was like 6 or 7%. It was basically overnight. And it was because it happened so quick, triggered stop losses, people liquidated out of their positions, etc. So we could see potentially another situation like that. This is the impact on the US government. So America's debt, we do have a problem with debt in America, obviously. 125% debt to GDP, which of course is not 240%, but it's still very high. Now, this higher rates mean there's higher servicing rates for the US interest payments. There's less budget for infrastructure, so reinvesting in the military and airports and all these different things, roadways, and also social programs. There's less budget for that, which isn't good. So Japan's structural problem is there's two major long-term issues at play. The first one that'll cause this to get worse is population collapse. The population in Japan is older. They're not as young. Last year, there was only 685,000 new births in Japan, okay? So with 128 people back in 2010, and there's only 122 million people today, they have a declining population projection. And by 2100, it's 75 million projected population. So with a shrinking workforce, that'll equal less tax dollars in. And then the worst part is, how do they manage this debt? Because they have 240%. So it gets to a point where, how do you wrap your head around this? And in my opinion, there's only three ways out of this situation. So these are the situations. There's not just this country in debt. And I will say this, there's Italy, France, United Kingdom. There's tons of countries around the world that are in massive, massive debt. The issue with this is everyone is competing for bond buyers. So they want those buyers to invest in their country so then they can keep reinvesting in their country. It's very simple. If there isn't enough bond buyers for the country, what happens is that country has to print more money, which is hyperinflationary because now they got to cover their debt with money that they're printing. So it's like double whammy going in the wrong direction. It's much better to have another country invest in your country. You don't have to print money, and then they can keep their cash in here. So here are the three scenarios. The first one that I think is most likely is a slower adjustment. So Japan gradually raises rates. Markets adapt slowly. The outcome is more of a soft landing, the best case scenario. Scenario two, a little bit worse. I think this one is a little bit less likely, but carry trade unwind. So rapid yield increases triggers massive selling of US bonds, market volatility, rising global interest rates. Now, a preview to this example would be kind of like Japanese investors sold 20 billion in bonds in weeks during 2025. So that we could see that happen again and exponentially. So maybe instead of 20 billion, we're going to see maybe 500 billion or 600 billion. So more of a heavier liquidation event, which could really affect the markets. Now, this is the worst case scenario, okay? In terms of a fiscal crisis, if debt becomes unmanageable, then we could see a repeat of the Venezuela event. As their population decreases so much, they could get in such a tricky position where they'll just print tons and tons and tons of cash and end up in a very hyperinflationary area. So this would be the absolute worst. Do I think that's going to happen? I mean, I'm not a major economist, so I couldn't tell you what's going to happen. But what I can tell you is that you could subscribe to this channel and take care of your portfolio by staying up to date with the news, which is what you guys are doing by making it all the way to the end of this video. So make sure to subscribe if you liked it. Click the like button and let me know what you think down below of the debt crisis. What do you think is going to happen in the market? I'm super interested to learn, and I'll try to do my best to respond to every single one of you guys. Take care.